Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we go.
The equity markets in New York, are they going to continue to rise? Any thoughts on that?
Well, it's been a fabulous bull market. It's run for 9 years, and we see that the big hedge fund manager, Ray Dalio, the other week pointed out that he thought that the stock market was in the 7th inning, and as we know, there are 9 innings to the game, so I guess he's saying each inning is a year. It's another. Then another quote the next day by him was another 2 years to go in the stock market. But this may be extrapolating things. The thing that we look for, of course, have been the other items that support the stock bull market. I mean, the stock market doesn't exist by itself. And there's a lot of people in our business that specialize just in the stock market. But at any rate, we integrate it with other things. And you'll remember that on October the 4th, we were looking for that everything would get bubbled, even the Dow Jones. And then the other part of that study was that some great speculations had peaked at the turn of the year, like December, January, gold in 1980, the Nikkei in 1989, and a number of other examples. So then that became our target, and so you had the dot-com bubble do an extra leg up, unbelievable, and that peaked in December. And then the one we look at for the whole market is the New York Stock Exchange Composite Index, which on stock charts is the NYA. So here, that's the whole broad market, and it took off and it really soared. So we measure momentum by the relative strength index, and the weekly one got up to almost 90, 88, which is exceptional for any index. So that was in January for the whole broad market. So I compared that to what the NASDAQ did in that incredible dot-com bubble that blew out in March of 2000. And on that one, the same weekly RSI got up to 84. So here you had the whole broad market was so speculative going into January that you had that exceptionally high momentum. And the NYA took as hard a hit as any, and then has been recovering since, but not to new highs. So with the hit, which we expected early in the year, we then looked for a rebound in things out to around May or June, and that would, with what we called our friends of the bull market, which would be increasing industrial commodity prices, the yield curve heading towards inversion, credit spreads narrowing, and other positive commodities. So that did indeed happen. And in May and June, the industrial commodities reached their best, and in particular, the one that was incredible was lumber. It actually clocked a bubble, huge bubble, up to 650, and now it's in June, and now it's down to 375. So that is not saying that the economy is going to continue to be good. Base metals had some nice rallies and have given up a lot. So on that sector, the industrial commodity side is now negative after being friendly. And the financial ones in the credit markets, spreads in the curve are, they're not, let's put it this way, they're not as friendly, but they haven't reversed yet. So so what we're just watching for here would be, now, like crude oil was one of the industrial commodities that was expected to be friendly out to around the middle of the year, and it has been trading in a range from sort of 69 to 74, and it had another quick spurt here recently. Now, this of recent decade or so has been positive for the stock market. But when we look at these industrial commodities, including crude oil can have an important low in December, January. Copper can have an important low in November. Lumber can also have a low in the fall. So there's a probability that these industrial commodities could weaken soon, or another leg down, and that wouldn't be friendly to the markets at all.
We'll have more with Bob Hoye right after the break.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Bob Hoye. Bob, cryptocurrencies, are they looking like tulips or the dot-com crash back in 2000?
Oh, it's like previous huge bubbles. Now, it's worth saying that on the cryptos or the blockchains and the Bitcoin stuff, the price gains were huge. But the action was similar to previous bubbles, whether it was in gold and silver in 1980 or the Nikkei. So when that blew out in December, the view was that, it's going to get hit hard because it was an extended bubble. And then the mystery was, would it be able to come down, correct the excesses, and go back up? And our view is that we thought it was unlikely because it had been such an incredible bubble. And over the last few months, it keeps making new lows. So all the lows since the first of the year have been taken out. So that then is like other previous great bubbles. It's over. Now, it was also a part of the huge bull market. So when you've had the most dynamic side fail, that's kind of a warning. But on the other side, you've got the marijuana stocks, which have been absolutely outstanding and maybe excessive now, but it wasn't as excessive as Bitcoin was in December. So we're dealing with fabulous market dynamics that at the moment are saying let's be cautious. A lot has been accomplished, and I don't know what Dalio is using to consider that this bull market has another 2 years to go. At the moment, if you see like crude oil selling off in here and another leg up in the U.S. dollar index, with the speculators will be hard-pressed to keep things going at that basis. So we're cautious. I've used the term, Jim, cautiously pessimistic. So, and let's be real, I think it's an appropriate stance to take, considering how fabulous the markets have been. And also we want to go back to November of 2016 with the election, and there was a bit of a down dip then, and our work on November the 3rd, the Chartworks came out with a springboard buy. And that was, of course, the week before the election. And, of course, since the election, you've had a change from the most anti-business administration in American history, I'm sure, to a very pro-business administration. And as the market lifted off in late 2016, we used the term that it was rational exuberance. And then now that you've clocked some technical excesses, it's no longer rational exuberant. It's just plain exuberant. So an exuberance cannot be sustained forever. And as I say, we know the items that will signal the next down leg in the stock market. So we'll be watching for them. And as I said, if you're specialized in the stock market, you may not be watching the industrial commodities or the credit spreads or the yield curve. And that all integrates together. So we'll be watching for change.
Do you watch the transports? Are they the big indicator?
Oh, yeah, they work. We haven't used that old Dow theory, Jim, for decades, but in 2015, the Dow theory started to work because I think the transports were not confirming the bull market then from about February on, and then April, we made a note on it that this now non-confirmation was important. And then eventually you had quite a sell-off on in 2015. That NYA, the broad market, went from 11,200 down to 8,900. That was into the early part of 2016. Oh, there was a crisis. There was panic selling in crude oil. It had fallen from 107 down to $26. So that was some pressure. So the thing to do is now there's a bit of a different thing on the old Dow theory, whereby the Dow industrials have not been confirming that the transports have been acting well. So it's a bit the other way around, but it could be an indicator in here. But it's not one that I'm resting a whole lot on. I'm staying with the dollar index and the yield curve and credit spreads and industrial commodities. That'll help us get around the corner here if there is a corner. So it's been fascinating to watch. Now, there's been great disappointment in the precious metals side.
Bob, maybe we'll talk about precious metals when we come back from the break.
Sure thing.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead, zinc, silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of northwestern BC. Check us out at blindcreekresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, what kind of action do you expect to see with gold and silver, which have been kind of disappointing, haven't they?
Oh, yeah. The gold and silver precious metals community has been quite disappointed because it was a long bear market from 2011 down to, I'm looking at the chart here, 2015, and then you had a sharp rally in the sector up to the middle of 2016. And that's when, the big boys in the gold business were calling for gold to run to $10,000. And then I can't remember his name at the moment, but he's supposed to have some special insight or connection with the CIA, and that helped him call for 10,000 on gold. But what more does the CIA know about precious metals than any other, thorough analyst? So at any rate, fortunately, we have history going for us, and on every great financial bubble, the real price of gold, and you get the real price by dividing gold's price by the CPI, inflation, and in every great bubble, the real price has gone down, and the real price indeed has rose to 2011 and has been coming down ever since. Now, it tried to stabilize through 2017, but in the last few months, that price of gold divided by the CPI has been going down, and you have had ostensibly the bull market in paper, stocks and bonds is still on. So one would expect the real price to be down. Now, where this connects to the gold industry is that if the real price is going down, chances are, if you were mining, the price is weak relative to your costs of mining, so profitability goes out. But then, of course, the other way around is when you get into a rising real price, then it represents that the price of gold is rising relative to costs. And in each post-bubble contraction, the action eventually shifts over to the gold sector because it's one of the few places that's making any money because the real price of gold is going up. So at the moment, the real price of gold is going down. And also we have another indicator, I call it a comfort indicator for the precious metal sector, and that is just simply the price of gold stocks divided by the bullion price, and we use the old Hoye index in gold, and it has been coming down. So that's not good for the sector. The other one is the gold-silver ratio. Well, let's flip it the other way, Jim. The silver-gold ratio in a bull market for the precious metals, silver always outperforms gold, and the silver-gold ratio goes up. And but this has not been the case because in bear markets or in different markets for the precious metals, silver will always underperform gold, which it has been doing. And until this turns around, you can't look at accumulating a position in the sector. But when it does turn around, at least we'll have the handle on it. And I think the better money is going to be made in the gold and silver stocks rather than trading gold or silver. And at the moment, it's you've got silver now. This week is taking out lows all the way back to, it's taken out the low in 2017. So it was 21 in 2016, and now it's down to, that $14 level. So it may fall further. It can do that if we go into a credit crisis. It'll be anticipated by silver being weak relative to gold, and that's ancient history. I mean, I've tracked that one back at least 400 years, where if you have the gold-silver ratio history annually, and if you know what's going on in the financial markets, that has been confirmed all the way back. So silver being weak now relative to gold is confirming that there could be a credit problem sometime in the next little while.
Bob, thank you so much for chatting with us.
Well, it's always good to be with you, Jim, and we look forward to next week.
Our guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for Bob or our other guests can be sent to info@HowStreet.com. I'm Jim Goddard. Have a great weekend.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.